Welcome to our comprehensive analysis of the GBP/CHF currency pair for the week of October 13th through 18th, 2025. In this video, we'll examine the technical structure, fundamental drivers, and trading outlook for this important cross rate. The British pound faced renewed pressure against the Swiss franc during this period as safe haven flows dominated market sentiment. We'll break down the key levels, economic developments in both the UK and Switzerland, and provide actionable insights for short-term and medium-term traders. This analysis draws on data from multiple leading Forex sources to give you a complete picture of where this pair is headed. Let's dive into the details. During the analysis period from October 13th to 18th, the GBP CHF pair declined by 0.66%, opening the week at 1.0723 and closing at 1.0652. The weekly low was reached on October 16th at 1.0648, representing a critical test of support levels. As of October 21st, the pair continues to trade lower at 1.0634, indicating persistent downward pressure. The chart clearly shows the steady decline throughout the week, with the pair unable to mount any significant recovery. This weakness reflects broader market dynamics, with the Swiss franc attracting safe haven flows while sterling struggled to gain traction despite some positive UK economic data. The pair tested and broke through several minor support levels during this period, setting the stage for potential further declines. The technical picture for GBP/CHF presents a fascinating divergence across different timeframes. Short-term indicators on the 30-minute and 1-hour charts are flashing strong buy signals, suggesting potential for tactical bounces. However, this stands in stark contrast to the medium and longer-term outlook. The 5-hour, daily, weekly, and monthly timeframes all show strong sell signals, indicating that the broader trend remains firmly bearish. This divergence suggests that any short-term rallies should be viewed as counter-trend moves within a larger downtrend. The critical support zone between 1.0600 and 1.0650 is currently under pressure, while the key resistance sits at the 50-day exponential moving average at 1.0763. Traders need to be aware of this time frame conflict when planning their strategies. The United Kingdom provided some positive economic news during this period. GDP growth for the 3 months ending in August 2025 came in at 0.3%, confirming that the British economy continues to grind forward despite global headwinds. The International Monetary Fund has forecast the UK to be the second fastest growing G7 economy in 2025, trailing only the United States. This represents a relatively strong performance in what has been a challenging year for global trade. However, the Bank of England remains cautious. Chief economist Hugh Pill has signaled support for a slower pace of interest rate cuts, citing persistent inflation pressures. Markets are currently divided on whether the BOE will cut rates at its November 6th meeting. While the GDP data provided modest support for sterling, it wasn't enough to offset the broader risk-off sentiment favoring the Swiss franc. Switzerland faces significant economic headwinds that are creating a complex backdrop for the franc. The Swiss government has slashed its 2026 GDP growth forecast to just 0.9%, down from a previous estimate of 1.2%. The 2025 forecast remains at what officials describe as a significantly below average 1.3%. The primary culprit is U.S. trade policy. Switzerland is currently subject to a 39% tariff rate on exports to the United States, one of the highest country-specific rates imposed by the Trump administration. The situation is even worse for pharmaceutical products, which face 100% tariffs unless manufactured in the U.S. This is particularly damaging given Switzerland's heavy reliance on pharmaceutical exports. Despite these economic challenges, the Swiss franc has gained 12% year-to-date as investors seek safe haven assets. This strength is creating additional headwinds for Swiss exporters and complicating the Swiss National Bank's policy decisions. The Swiss franc emerged as the top-performing G10 currency during the analysis period, driven by a powerful wave of safe haven demand. Several factors converged to trigger risk-off sentiment across global markets. Concerns about U.S. regional banks sparked worries about financial stability, prompting investors to seek shelter in traditional safe havens. Gold reached fresh record highs during this period, reinforcing the flight to safety. U.S. 10-year Treasury yields fell through the psychologically important 4% level as capital rotated out of risk assets. The currency performance chart clearly shows the franc's dominance, with the Japanese yen also gaining as another safe haven currency. The British pound, by contrast, showed weakness, declining against the dollar during this period. The technical breakdown in GBP CHF was particularly significant, with the pair collapsing through the 1.0610 to 1.0658 support zone, confirming that the bearish structure has resumed. Understanding the key technical levels is crucial for trading GBP/CHF effectively. On the support side, the primary zone between 1.0600 and 1.0650 is currently being tested and represents the make or break level for the pair. If this zone fails, the next support sits at 1.0582, which is the 52-week low. Below that, the major downside target is 1.0413, representing a 100% projection of the previous decline. In an extreme risk-off scenario, the pair could even test 1.0183, which was the low reached during the 2022 market turmoil. On the resistance side, immediate resistance sits at 1.0700, but the more significant level is the 50-day exponential moving average at 1.0763. A sustained break above this level would be required to signal a potential trend reversal. The major resistance cap sits at 1.0778. The chart clearly shows how the current price is hovering dangerously close to the critical support zone, with multiple resistance levels capping any potential recovery attempts. For the next 1 to 2 weeks, we expect GBP/CHF to trade within a range of 1.0580 to 1.0780. The critical support zone at 1.0600 to 1.0650 is under intense pressure and will be closely watched by traders. A decisive break below 1.0600 could trigger a cascade of stop-loss orders and push the pair down to test the 52-week low at 1.0582. Conversely, if the pair can hold above 1.0650 and push through 1.0700, we could see a rally towards the 50-day exponential moving average at 1.0763. There are some technical factors that could support a short-term bounce. An inverted hammer candlestick pattern has appeared on the daily chart, which sometimes signals a reversal. Additionally, the positive carry trade for holding long GBP/CHF positions provides some support. However, traders should be cautious about fighting the broader trend. Any rallies are likely to be counter-trend moves within a larger bearish structure. Looking out over the next 1 to 3 months, the outlook for GBP/CHF remains firmly bearish. The bearish structure is intact as long as the pair remains below the 1.0778 resistance level. The chart shows 3 potential scenarios. The base case bearish path projects a gradual decline towards the 1.0413 level, which represents a 100% projection of the previous decline from 1.1204 to 1.0658, measured from 1.0959. The extreme bearish scenario, which could materialize if risk-off sentiment intensifies, targets the 1.0183 level that was reached during the 2022 market stress. There is also a recovery scenario shown, but this is considered less likely unless there's a significant shift in market sentiment. The midterm trend will be heavily influenced by several factors: global risk sentiment, the direction of equity markets, and any developments regarding U.S. tariff policy. If the Swiss franc continues to benefit from safe haven flows, the downward pressure on GBP/CHF will likely persist. Let's summarize the 5 key takeaways from this analysis. First, the bearish technical structure has been confirmed by the collapse through the 1.0610 to 1.0658 support zone, with multiple timeframes showing strong sell signals. Second, safe haven demand is driving Swiss franc strength, with the currency emerging as the top G10 performer amid concerns about U.S. regional banks and broader geopolitical uncertainty. Third, there's an interesting economic divergence between the two countries. The UK is showing resilience with 0.3% GDP growth and positive IMF forecasts, while Switzerland faces significant tariff headwinds with its 2026 growth forecast slashed to 0.9%. Fourth, we're at a critical juncture. The support zone at 1.0600 to 1.0650 is the make-or-break level. A break below could trigger a cascade to 1.0582 and potentially 1.0413, while recovery requires a sustained move above 1.0763. Finally, for trading strategy, watch for a break below 1.0600 for further downside opportunities, or a recovery above 1.0763 for a potential trend reversal. The short-term trading range is 1.0580 to 1.0780. Thank you for watching, and please subscribe for more Forex analysis.